40s sounds nice, man. 30s has been like 20s, kind of, with more money and more kids. 40s will hopefully be just kind of setting the stage for peak earning years starting at 50. More travel in my 40s is what I would anticipate. Speaking to the, I guess you're not a wily veteran in your 40s, but you're there now living it. Tell us, BH, what's 40s like compared to 30s?
See no difference.
Yeah.
No, I should say I see less hair. That's for sure. If you get in on that,
Yeah, I'm headed down that boat, bud. I'm headed down that boat.
and I don't think I want to do hair plugs because I feel like that's just a temporary thing that I got to go over and over and over again. And I'd rather just go bald and shave it and have a nice, hopefully have a nice dome when it's shaved.
You look like you have a nice dome. Like the geometry of what you got going looks fine. It's honestly, and I've thought of this before, so this is the first time I've said this to you, and definitely the first time I've said it live to our 1 million followers. And hey, Mom, you have like I feel like a Kobe dome, which is a good one.
It's round.
You can also grow a beard, can't you?
I don't know. I don't think Victoria would approve of a beard.
Look, man, you're your own man, okay?
No. Don't go that way. You don't just do whatever you want to do. You can't grow like a mustache with little loops on the end. You can't grow like just a soul patch and everything you do. Schaefer's like, whatever you want, you do it.
If I can get the photo in time, I'm going to give it to Veronica of when I grew a crappy mustache during COVID, and it was on me for a while, including client meetings. So gotcha there, buddy.
And Schaefer was like, this is great. I love my husband. Keep it. Do whatever you want. Welcome, viewers, to episode 31 of Talk Your Chart. Today is March 22nd. This is Brett Horowitz here with my colleague, Marcos Segura. Marcos, I want to start off with a quote from a very famous president about 90 years ago. He started off one of his fireside chats with the sentence, I want to talk for a few minutes with the people of the United States about banking. Any idea who that's in reference to?
I know that Franklin D. Roosevelt was a fireside chat guy, I think.
Yep.
It was him, right? Okay.
Really similar to what was happening there.
Yeah. Okay. Nice one. I thought it would have been good if you dressed up like him, but this is a good way to do it also. Wow. Majestic. Man. So you took the cue. Mine's too little. Volker's still back there looking at us. All right, Brett, like you mentioned, it's March 22nd, 2023, and a lot of things have happened in the last 2 weeks. And banks are on people's minds. So I think today we agreed that we'd stick to one topic and charts surrounding that one topic. I want to start, however, with something a little bit kind of more macro on top of the whole thing. And I know you have a ton of charts for us that are specific. I want to talk credit cycle, because when you look at this, and if you watch where I recommend a lot of viewers go, Ray Dalio's video, How the Economic Machine Works, 30 minutes long, worth your time, talks about credit cycles. I want to go over a 13 rinse and repeat process that I think helps frame everything, and then we can get into details. I got all this from a gentleman I follow, Cullen Roche. Dude's highly intelligent, and I loved how he framed it. So let's kind of follow. So the first chart that I have here, Brett, and I just put this together, it walks through what we're going through. All of these points could be a chart in and of themselves. We just didn't do that, right? So what do you get first? Chicken or the egg? You get economic expansion. This leads to, from economic expansion, you get an economic boom, which is all feel good, but that's when the excess begins to bubble. Inflation then moves beyond the Fed's target. Okay, that finally happened after 15 years of it not happening. The Fed raises interest rates. Then we get a rate hike that's always lagging, and the Fed keeps raising. And this is now everyone kind of to bring it to present saying, everyone's saying the Fed is late. Step 6 here, you get a yield curve inversion, which is bad for banks, and we'll talk more about that. August 2019, by the way, and July 22 were when the yield curve inverted, talking about the 2 and the 10. The Fed stays tight as inflation data remains sticky. And then here's the how far and fast is too far and too fast, which is what we're getting into, consumers then borrow more to make up for lost income. Lending standards increase, meaning it's going to get harder to get access to credit or it will be more costly, which meaning credit expansion goes down. Are we here? We'll see. Probably. Economy slows. Why? Because credit is the most important part of the economic machine, but probably the least understood, right? Recession comes, Fed reduces rates, rinse, wash, repeat.
So are you saying this has to happen every single time like this? You're saying every one of these situations has happened like this, or this is just generally how it happens?
I think that you can never say it's perfect because this isn't physics. I'll quote Richard Feynman when he said physics would be a lot harder if electrons had emotions. Why do I mention that? Because what makes this credit cycle or economic machine keep going are people, and humans are emotional, whether that's on the excess side or on the opposite end. And I think this credit cycle is kind of a physics way of looking at things. But since people are the underlying mechanism under all of this, it gets messy. So I think hindsight, BH, you can look back and point to all these things. I think it's very hard to do it, if not near impossible to do it while you're in it. But I think knowing the framework is super helpful.
Well, this is why, I mean, if we're on 8 and 9 now, right, somewhere in that place where consumers are borrowing more, and now you've got this banking situation that could lead to banks loaning less money out. That's why a lot of people think the Fed is not going to raise as much as they normally would, because that naturally slows down the economy, because banks are less likely to loan, people can get the loan, so money starts to slow in terms of being in motion. And so that's why instead of saying it's guaranteed the Fed will keep raising rates today, there's some thought that says maybe they'll stop, maybe they'll pause, see how bad this banking system is.
Maybe. I hope they don't pause, but I agree. Let me kind of button it up here with a quick summary of kind of where we are and start, and at least where we are now, 10, 15 days in. We had a fiscal stimulus and easy Fed policy for a long time that led to an asset price boom. Banks piled into bonds at low rates. The Fed then kills bonds with fast rate hikes. Banks are potentially insolvent if marked to market on their securities books. And then specifically now what we're looking at is small banks are heavily put under the microscope as people kind of consider who would or wouldn't be bailed out. Is it top 6 banks? Is it not? Do uninsured deposits matter? A quick kind of idea here on uninsured deposits. This is not new. There have been uninsured deposits for forever. The fractional banking system that we work off, which means that banks never have all of the money all of the time, has been in existence since like medieval Italian times, right? It's what always happens. It's the same idea as LA Fitness doesn't run a business where it says we need to have 100% capacity for 100% of our membership to be using the gym at the same time.
Right, but
It wouldn't work.
do you believe that the consumer should be looking at their bank if they have an uninsured deposit and seeing if that bank, going through the bank's financial statements and determining is that bank in good shape or not? Like, do you think that's reasonable for the consumer to do? Somebody made the analogy. It's like, do you inspect an airplane before you fly it? Or do you look at all the drugs, how a drug works before you take it? Or do you just rely on agencies to do their work?
From my perspective, I don't think it's reasonable to expect consumers to go through that. That's me. That's all. That's a simple answer I'll give. I don't want to make it any political or social commentary. I think from my perspective,
So then take it a step further. Do you think that they should raise the limit on FDIC, or do you think that they should basically come out and say, if you have a deposit, we will cover you, the government?
Yeah, so I think they could very easily raise the FDIC limit like they already have in the past. I think the reality is that the majority of regulars, so to speak, don't have uninsured deposits, and a lot of the uninsured deposits are concentrated at the top or on corporate balance sheets, right? So I think there's a different level of sophistication that comes there. So do I think that FDIC insurance needs to be unlimited? Probably not, even though I think we all know that it is.
I mean, having Roku having $50 million in one of these banks that went belly up, like that'd be awfully hard with a $250,000 FDIC limit to spread your risk into so many different banks. So
No.
maybe they have the capacity to do the research. They've got the professionals that can look at the bank, but that limit is so small compared to what they had. Just seems like it's a little ridiculous. For you and I, it's more than enough, and for the average person, more than enough. But
look, I think so. So look, let's take that pivot real quick. Regulators have egg on their face from my perspective, and given what I'm listening to reading. My next chart here is the Federal Reserve board members put together their economic projections. I've showed this before. I'm showing it again because, man, this is where everyone gets marching orders from. Look at this chart. And if you look at the highlighted piece here down at the bottom left, it shows the federal funds rate, which this was put out in December, on December 15th of 2021, where the Federal Reserve, the people and that Jerome Powell leads, said, we think it's reasonable to expect that the median Fed funds rate, the end of 2022 and going into 2023, is going to be 0.9 to 1.6. And then took rates from 0 to 5.
well, yeah, I mean, we were sitting so pretty at the end of 2021. That's when the market hit its all-time high. Inflation was low, growth was strong, everybody was flush with cash.
But this goes back to like the Fed was late again. And now not only were they late, you put the entire system in a position, because look, this is like the banks, this is what they do all the time. They borrow short and lend long, right? That's like the whole banking model. They're going to pay you short rates and they're going to get paid long rates. And that's why it works. And your deposits are never 100% sitting there, because credit creation is what makes our economic machine work. But
Right.
It does lead to boom bust cycles.
And it also say, though, if you had a client deposit money with you who said, look, I want you to invest this money for me. And you said, okay, when do you need this money back? And they said, I don't know, it could be next week, could be next month, it could be next year. You'd be hard pressed to say, let's put it into a stock market or to a 10-year bond or a 30-year bond, right? With all that money, you might put some of that in there, but knowing that the client could take it back in a week or a month, right? Like a depositor could in a bank, you kind of don't want to put all that money to work as a loan or as an investment.
Yeah, I understand. And look, banks are not people. They have limited things that they can invest in, right? You can maybe talk more about that relative to Silicon Valley Bank and that idiosyncratic risk that they run. But a bank can't do whatever the hell it wants relative to their loan book,
Right.
Especially the bigger banks. So that's it. So look, my perspective, how do regulators not look? You asked the question about should consumers be looking at balance sheets and all this stuff? Maybe, maybe not. I don't think so, but that's an opinion. I think regulators definitely should. And if they knew what was sitting on bank balance sheets when they were buying 10-year debt at 1.5%, and they were going to crank rates up, like, what's going to happen there. So regulators have egg on their face, my perspective.
And the auditors as well. Auditors got caught as a few weeks ago saying all these banks were in good shape when they were not in good enough shape. Now they wouldn't have known there would be a run on the bank, but still.
Yeah, and that's the other issue. And again, you can clearly tell Silicon Valley Bank didn't think there'd be a run given the order of their operations relative to selling their bond portfolio and then raising capital. But anyways, man, that's my chart. What do you have for us here?
So I want to talk about specifically what happened to Silicon Valley Bank, and then take it out higher or a bigger picture and talk about someone like a Schwab or a Vanguard or what's happening with other banks that are out there. So a lot of people, I think, are asking, what happened to Silicon Valley Bank? Could this happen to my bank? What's the problem? Can you please explain it to me a little bit more detail? And the bottom line is, I start here with the balance sheet. And basically what we can see here is that they have assets. These are all in billions of dollars. So 13 billion of cash and 26 billion in available for sale securities. But basically, they're taking between the second line, the 26 billion and the 91 billion held maturity securities, and they're investing depositors' money, just like you said. They're not just all going to keep it earning nothing. They're going to buy bonds with that and hope that those bonds make more than what they're paying out to their creditors or to depositors. They also do some loans in here as well. And so they're doing all that, hoping that ends up working out in their favor. But the reality is all of those deposits are a liability as well, because tomorrow those depositors could come in and say, I want all my money back. And so you've got to be careful you don't have too much money at risk. and too much money tied up in what's being loaned out and what's being put in securities.
Yeah, it's funny how kind of banking 101, everyone did learn a little bit more, because maybe it's not 9 out of 10, but call it 7 out of 10 people think that a deposit is an asset of a bank. It's not, right? Like that's the liability, because they owe you that money. The asset is the loan they make with it, or the asset they buy with it. So if you get deposits just flying out of the bank, well, yeah, they can cover a portion of that. But behaviorally, if you're worried about, wait, if Brett leaves and this guy, maybe I need to be first, i.e. a bank run, the digital stampede, which I think is the perfect way to frame what happened here, is what became an issue as deposits flew away to go earn 4% in money markets and leave the 0.5% in a checking account.
Yeah, I mean, I don't know if it was necessarily their fault, maybe some bad timing in there, but it started off with just, they took a little bit of extra risk here to try to make some more return on their money, which all banks do. But combine that then with a couple more charts, which is the next one, shows the balance sheet growth. SVIB had this enormous growth in their balance sheet. So that means all these firms they work with, all these depositors, put a lot of money into the bank in a short period of time. And you got to know that all that money could come back out as quickly as it went back in. Add to that the fact that 90% of the depositors had uninsured deposits, which means they had balances over the FDIC limit. So if you and I are at the bank and we hear that somebody else is taking their money out, we're going to call the bank quickly as well, try to take our money out, because we don't want to run in the bank and be the last one stuck there and not be able to get our money out.
Yeah.
It's not just unique to them. There are other firms that are out there that have a lot of high share of uninsured deposits. But those are going to be more at risk, because as soon as you hear a whisper saying this bank's in trouble, everybody rushes the exit at the same time.
Yeah, only Signature Bank had more uninsured deposits than them, right? So it's not ideal.
And then the last thing would be the next chart showing who they funded to. You've got a lot of technology companies in here. The red are going to be your private bank, your regular customers who maybe have a smaller balance, but they relied on tremendous amount of early stage companies, technology companies who did so well during the pandemic. And then in what we saw in 2022, started to lay off a lot of workers as well, happening in 2023, and needed that money back. So this is why all the money came in, all the money is now going out, and they invested that money in things that lost money. And so now they're stuck selling that at a big loss.
Yeah. So Mike Semblist at JP Morgan articulated this well, and I think this is his chart also. He, SVP, so Silicon Valley Bank, took the most duration risk on their balance sheet and also had the riskiest deposit base, right? So duration risk is interest rate risk, right? You buy bonds, rates go up, it's bad for the bond price. So they did both those things in combination. With that kind of signals the bad management stuff. They also had the highest share of non-operational wholesale deposits, which this I learned and I would not have known without this little mini crisis here, many so far. That is the hottest type of deposit, hottest meaning the most likely to leave at any moment. And what is a non-operational wholesale deposit? That is a spare cash that institutions and corporations place with banks in excess of the amount they need to serve their day-to-day needs. So that type of deposit is the hottest one in town, right? That's not me telling you, that's industry standard.
I think
they had a lot of.
I think I read that they paid out a slightly higher rate on their money markets and on their cash than other banks. And they're probably more likely to make loans than maybe your larger banks out there. So I think you had a lot of people that put their money in there. But I want to compare them to someone like a Charles Schwab. Charles Schwab is a public company. Lots of our clients have money at Schwab. Schwab has a bank as well. And one of the notes that I read about recently was the fact that Schwab's loan to deposit ratio was only 10%. So they don't take a lot of that cash that's in the accounts and loan that money out. And the uninsured deposit rate is only 20%, which means 80% of the customers have money below the FDIC limits. So if you have money at Schwab or Schwab Bank, and you're below the FDIC limit, you would not expect a run on the bank simply because most depositors have a small amount of cash at Schwab.
Yeah. The balance, it's not comparable to Silicon Valley Bank. And when you look at these charts, you can see that Silicon Valley Bank was in just a league of its own.
So before, and so that makes a good point is, so how are the rest of the banks doing? So I've got a chart here showing sort of what they call their tier one banking capital ratio. and the loan to deposit ratio of all banks. Basically, tier one capital, I'll read the definition. Tier one capital is the core capital held in a bank's reserve used to fund business activities for clients. And so basically, you can see here from this chart that over the last 30 years, tier one has gone up for the most part, which means banks are more well suited to manage their assets.
Yep.
And that the loan to deposit ratio has for the most part gone down. So you're not looking at the banking industry as a whole, I don't think, in trouble. I think this was specific to a lot of regional banks who had uninsured deposits, who basically loaned and borrowed more and invested more where they shouldn't have, and not that this is a giant situation going to hurt every single bank out there.
Precisely. And so a couple points. The first thing is, no matter how awesome a bank looks at the end of any reporting period, if there's a run on the bank, they're no longer going to look good. Like if JP Morgan had every single depositor just decide to pull all the cash out, they'd go from a great looking business to getting bailed out. Like no bank survives a bank run. That's kind of the point. The problem with a bank run is that it's a behavioral phenomenon, not a financial. Right. And the big difference here, because obviously GFC, great financial comparisons, great financial crisis comparisons are coming up. Back then, you actually had assets on bank books that were actually worthless. Like they were toxic assets for real. This time, it's a confidence crisis that was sparked by a mismatch in duration, right? The interest rate risk stuff that was precipitated by all these rate hikes, but ultimately the asset we're talking about is a US Treasury. By and large, yes, there are some mortgage-backed securities there also, but very different from a composition standpoint than what we had before.
Well, before, going back to even 1930s, you had lots of banks fail, and that's where Mr. FDR came in to talk about, we're going to do a banking holiday, we're going to add FDIC insurance, your money is safe, because you're right, if everyone wanted to pull their money out tomorrow, every bank would be in trouble. The point of this is that it's confidence, and then if you show that the banks that you got these insurance, you shouldn't have everybody rushing the doors at the same time.
Yeah, I agree.
But I just want to follow up with one more point about rushing the door, which would be what happens to brokerage firms if everyone rushes the door? What would happen if everybody took the money out of Schwab or took the money out of Vanguard or any of these firms? What happens to your assets? Are they protected or not?
Okay. Are you going SIPC here? I hope so.
Yeah, basically, partly SIPC, but I've got statements from both FINRA and from Vanguard sort of showing what would happen in those situations.
Okay.
The first one in FINRA, it says in virtually all cases when a brokerage firm ceases to operate, customer assets are safe and typically are transferred in orderly fashion to another registered brokerage firm. That's what happened with Lehman Brothers. That would happen if Schwab or Fidelity or Vanguard, whoever went out of business, because they don't own your assets, right? You own your assets. They're being held there. And in effect, if they went out of business, your assets would be moved to somewhere else. So your money is not at risk.
Yes.
Vanguard even goes a step further, where it says that securities that underlie the funds are held by a custodian, not by Vanguard. Vanguard is paid by the funds to provide administration and other services. If Vanguard ever did go bankrupt, the funds would not be affected and would simply hire another firm to provide these services. So again, to us, to me specifically, and maybe I'm sure you feel the same way, assets that I have at Schwab or that our clients have, wherever they are, I'm not concerned about those. And as long as they keep their deposits within 250 at a bank, I'm not concerned about those as well, even if there is a run on that bank.
Yeah, absolutely. And even uninsured deposits, again, I feel like a lot of people thought uninsured deposits were like a dirty secret. This is not surprising. This is how the banking system works. Not all the things are insured, right? So I'm happy you brought this up, because meaningful difference between having assets at a bank or having assets at a brokerage. Schwab markets itself as a entity, financial services manager, whatever you want to call it, that has $7.7 trillion that they serve or manage, or again, whatever word you want to put. When it talks about that, I say, okay, great, $7.7 trillion. If you go to their balance sheet, right, the corporation, like the bank, it's 551 billion. What happened to the trillion? Well, that's because, to your point, the stuff that you have in the Vanguard ETF or the Schwab ETF or the fill in the blank mutual fund is not on their balance sheet. It's held somewhere else in your name. So if Schwab goes away, those assets are not theirs for creditors to pick at. Those will simply change custodians and your statements will have a new logo once the receivership process is done. So that's why you always say you'd rather own a treasury bill or a money market mutual fund as opposed to having a ton of cash sitting on in a checking account, because that is a liability of Schwab Bank.
Yeah, perhaps there'll be more shoes to fall in the next few weeks.
Could be.
But for now, I would not advise clients to take all their money out, put in a shoebox under the bed, and just leave it there. Thankfully, we have the FDIC, we have a SIPC, which is investor protection against fraud for security. So we've got protections out there, and that's why the market has calmed down the last few days, but we'll see what happens.
We will. March 22nd, we got Jerome talking this afternoon. We'll see what direction they decide to take.
All right. Good talking, Marcos.
Until next time.